Good morning, good afternoon, and good evening, everyone, and welcome to What Happens Before and After the Pitch. My name is Allison Berardi, and I'm with the Nasdaq Entrepreneurial Center. For those who may be new to us, the Nasdaq Center is a nonprofit dedicated to helping entrepreneurs across the knowledge, mentorship, and resources they need to start and grow successful businesses. Today's session is designed specifically for founders building companies with significant growth ambitions. Whether you're raising capital, managing venture investors, scaling go-to-market, entering new markets, or preparing your company for long-term scale and exit opportunities. Many of you are operating in environments where speed, scale, and capital efficiency matter, and where decisions are shaped by investor expectations and rapid growth. This programming is intentionally built for founders navigating that kind of trajectory. Before we dive in, I'm going to launch a few quick polls so we can get a sense of where everyone is in their journey and the temperature in the room. We use this feedback to help shape the programs and resources we provide for this global community of entrepreneurs. While you're answering, feel free to drop in the chat where you're joining from today. We always love seeing the range of places founders are dialing in from. We'll also have a live Q&A at the end of the session, so please feel free to submit questions anytime using that Q&A feature. And while the poll is running, I'd like to briefly recognize the incredible partners who make these programs possible. The work we do at the Nasdaq Center is supported by organizations including Nasdaq, Wells Fargo, JP Morgan Chase, KPMG, Walmart, the Asia Innovation Hub, Wilson Sonsini, the Narrate Foundation, KKR, BPM, and Blend 360. Their support helps us expand access to resources and knowledge for entrepreneurs everywhere, and we're grateful for their partnership. So now let's get started. Without any further delay, please join me in giving a warm welcome to our special guest, Rachel Baruch, partner at Growth Warrior Capital. Welcome, Rachel.
Hello. Zoom had a little bit of delay there. Really great to be here. By way of quick introduction, I've been an investor for 10 years, investing in everything from the early stage all the way through to growth and pre-IPO. I'm currently a partner at Growth Warrior Capital. We're an early stage fund completely focused on industrial AI and AI in the physical world. And really excited to be here.
We're so excited to have you because what this subject matter has been requested in our community. So we are very excited for this conversation. So let's launch. Founders often focus most of their fundraising preparation on the pitch itself, but investors begin evaluating opportunities long before that first meeting. What is typically happening behind the scenes before a founder ever gets in the room with you?
Yeah, such a good question. I don't know if founders realize this, but we are thinking about you all the time. And before you even come across our desk and before we even know that you exist, we are thinking about your industry and we're thinking about, our connections and we're thinking about how all of that fits together into not just an investment that will make money for our LPs, but also fits together in a way where we'll be able to add value and be helpful. And so by the time you do come across my desk, we already have a perspective on your industry, on what you're building, on who we can connect you to, on what your go-to-market maybe should look like. And so when we're coming into that first conversation, we've oftentimes already thought about what a lot of that should look like. And so some of that first conversation is almost confirmatory for us.
Yes. So, just a little bit more about the opportunity when it first comes across your desk. What signals make you want to learn more about a company? And what can founders do to establish credibility with you before that first conversation?
Yeah, it's a good question. And I think that it connects a little bit to sort of this intense concept that I think is a little bit too prevalent in the VC world, which is that you need a warm intro in order to have a conversation. And it's just not true. I mean, sure, there are some investors who will only take a call if you've been introduced, but ultimately, we're looking for opportunities, and speaking generally for LVCs, like we're looking for opportunities that fit what we're looking for, that we think are going to be really, really valuable, where we think we can add value. And so when you're sending that cold email or when you're asking somebody to forward an email to us, the things that we're looking for are pretty obvious, right? Like we want to know, who are you? Why are you the right person to be building this? Where are you, right? Like if you're emailing an investor who only writes checks into companies doing $10 million of revenue, you want them to know upfront, hey, this is where we are. And so the more kind of basic bullets of information come through in that first email, the more likely I am to read it, the more likely I am for it to mean something to me. And it makes it easier for me to get on the phone and take that call or to let you know, hey, great to have you in my inbox. It's not a fit, but actually here's 5 people that it could be a fit for.
Yeah. So putting the onus on the founder to really do their homework before reaching out to you to make sure there's alignment sounds like it's really, really important. But
Yeah.
go
I was
ahead.
gonna say, I think it goes a long way. And, at the end of the day, I think something people forget is that we're all humans. And you know what? Like you saying, hey, I saw you went to NYU and, you were in the painting club. I was also in the painting club at NYU. Little things like that, like they really go a long way. And so, don't underestimate that human connection. And I think it's always worth, taking a peek, look at the VC's LinkedIn that you're reaching out to, take a look at their Twitter account. If you emailed me during football season and you make a football reference, like higher chance of me getting on the phone with you. The little human things really, really, really do matter.
Such great advice. Investors are evaluating everything from the market and business model to traction and the founding team. How do you weigh these different factors when deciding whether an opportunity is worth pursuing further?
So, you know, I won't say they're all weighted equally, but when you're thinking about that first conversation, the most important thing beyond even just the actual numbers is making sure that everything is coming across clearly. Because maybe the number one thing, and I see actually my summer analyst is on this call, and so he can plus one to this, but one of the things that is going to get you across the first call finish line is making it really, 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 really easy for the person that you have that first conversation with to call their team and explain what you're doing. And so, the better job you could do at that, the more likely you are to make it to a second conversation. Metrics matter, but metrics are metrics, right? Like your revenue is 500K or your revenue is 2 million. You can't control that for that first call. You can't control where you are. What you can control is helping me to understand exactly what you're doing in a way that makes it easy for me to explain that to my partner, exactly where you are in a way that makes it easy for me to compare it to other companies in the space, and exactly why you are the right person to be doing this. And if all of those things are coming through clearly, I don't know why my camera is bouncing back and forth. If all of those things are coming through really clearly, that will tell the story of why you deserve a second conversation.
So helpful, these tips. I just wanted to zoom out a little bit because VCs, they really are experts at trends. Can you just explain that and why that's so important for the work that you do and just helping our founders understand that piece, I think is really important.
Yeah, I'm gonna try to answer your question, and if I'm not answering what you're actually asking, just hop in and let me know. But I think one of the things that make VCs good at what they do is being voraciously curious. I am somebody who, if you mention something that I'm not familiar with, you will catch me by the end of the day having read everything that I could get my hands on that subject. And the same is true for what is going on around us. And I've lived through a lot of interesting cycles, and I think it can be really, really easy to get caught up in what's trendy right now, and what's cool right now, whether that is specific types of cryptocurrency or NFTs, or codecs. And what can be really difficult is actually staying grounded in that. And so, for us, we're thinking a lot about what's going on in the world, what people are excited about. We're tracking public markets to understand where the money is. We spend a lot of time also talking to buyers, right? We spend a lot of time with the folks who are actually making decisions about where to put enterprise dollars towards software. There's a lot of signals that are kind of bouncing off the walls at all times. And a lot of what we do is try and make sense of all of that while also staying grounded in, our core beliefs. And, whenever a founder comes in and pitches an opportunity, we're measuring it against everything else that we know. And that might be similar companies that we've seen in this cycle or prior cycles. It might be that a founder comes in and, it's clear that it's a really, really smart founder, but maybe not the right person to be building that business, right? Maybe they saw something was trending. They were like, great, I'm going to make some money off of this. Um, and that's fantastic. And oftentimes those are really good businesses to own and to sell, and not necessarily to take VC investment into. And so, we really try and kind of stay up on everything that's happening from every source possible so that we can make really, really informed decisions when we are making investments.
Thank you so much for that. So, this question really relates to how can you direct founders without a lot of networking? How can they start to begin to network and get on investors' radar and earn a first meeting?
Yeah. Such a good question. I mean, honestly, I think that cold outreach is really, really effective. Particularly, Allison, to your earlier point, when work is done upfront to make sure you're reaching out to investors who are a fit for you. So, number one, get on LinkedIn. You probably already have a list of investors that you'd love to work with, and work backwards, right? Like you probably have your top five wish list of if this guy wrote me a check, I would say yes immediately, and work backwards. Figure out, okay, there's funds I know I want to work with. Reach out to them. Some of them will direct you to other funds that are similar, maybe a better fit for you. So that's number one, like really never underestimate cold outreach. Some of the most successful fundraising processes that I've seen from founders who were not super well networked, they're founders who had a spreadsheet of, 500 investors to start that just got narrowed down and narrowed down and narrowed down till it was really clear, like these are the 20 people that I know want to invest in this type of company. I'm going to reach out to them with really personalized emails, make it really clear why they should get on the phone with me. So that's number one. Number two, networking events. I know we only have so much time in the day, but they go a long way. And I think that, going to events like that and literally just telling your story over and over and over again, you might not run into somebody there who is going to invest, but you will almost definitely get two or three or 10 connections to people outside of that circle. And so a lot of it is really just getting yourself out there. And I think, I don't know how aware founders are of this, but on the venture side, our job is to find you, right? Like all day, every day, I'm trying to figure out who is building the next big thing and where they are. Like I am out here hunting you down, right? And so, we really want to get emails from you. I think that, people are scared to send cold emails. People feel like, oh, like there's so many other companies that are better than mine. No, like you guys are building it and we want to hear from you. And so, I think a lot of it is literally just getting over that hump and being willing to feel a little uncomfortable in order to get in front of the investor that you want to work with.
That is so helpful, Rachel. What would you say is the best use when you're working with your founder pipeline? What do you hear from them in terms of using the large language models?
In terms of just kind of building investor lists.
Yes, exactly.
Yeah, I mean, I think, don't replace your humanity with AI because I think, again, like, because we read so many emails, I certainly get emails where, somebody has not even removed the here's a great email to send to an investor in the email. So don't do that. But I think that they're excellent tools to help you parse through a really big world of investors to figure out who is a good fit for you. And I've got no issue either, like with, you using an LLM to make a list of investors who are a good fit, figure out from LinkedIn what personal connections you have to them. I think ultimately, like, I do think that generally it's pretty easy to tell if an email was written by a human or AI. So I'd recommend for your like top 10 list, write that email yourself. But, the tools are there. And so I would absolutely use them, especially when you're talking about, taking a world of data and parsing it down.
Wow, this is so helpful. Okay, once the pitch is happening in your office, or on Zoom, what are you listening for beyond the information contained in the deck? And I'll ask you that first part, and then we'll go
Okay.
into the second part of the question.
Um, what am I listening for? The big questions that I'm asking myself really throughout this whole process. So before the pitch happens, when an email lands in my inbox, on that first call, how big can this thing get? And what are the proof points behind that? Is this the right person to be building the business? And what's happened so far that proves those two things to be true? And so, what I really want to hear is, I don't know, if you're building fishing company off the coast of Alaska. Like, I want to hear your family's been fishing off the coast of Alaska for 100 years. You've been fishing off the coast of Alaska since you were in diapers. It's all you think about. You know it better than anybody. You know everybody in that market. Because of that, you have your go-to-market down pat. It's really clear and obvious how all of that's going to happen. Then I want to hear that there's already really clear traction beyond just selling to your dad and your brothers. Um, and I want to see the backup and proof points behind that. And then I want to understand, what's happened so far, right? Like, what have you already built? How real is that? What are the dollar and metric proof points that tell that story? Those are the things that I really want to come away from on that first call.
Great. And you're doing a lot of evaluation. Are you also really, asking like very pinpointed questions? Do those change based on, the different meetings that you're having? What are the common questions?
Ooh, interesting. Really putting me on the spot here. It really depends on the pitch. And what I'll say on that is I think that founders, especially on the earlier side, get really worked up about it being a literal pitch. The best pitches that, I have experienced are conversations. And so there aren't questions that I'm going to ask every single time. There are things that I want to hear every single time. You should know your metrics, you should know your revenue, you should be able to tell your story again in a way that's so simple that I can repeat it. And I think, especially in the industrial space, and especially with AI, and especially with how complex so many different things are getting, a lot of founders are too smart for their own good. And so, they come kind of from up here. And what that means is that throughout the pitch, a lot of the work I'm doing, instead of asking you questions about your business, is I'm mentally trying to understand what you're saying. And that's not good for you. And so, keep it simple, keep it clear. I tell people often when I'm helping founders prepare their pitches, if you've got a, toddler, if you got a little niece or nephew, like, explain it to them. And if they don't get it, it's not simple enough. And so that's really the best thing that you can do in that pitch. Make sure that the investor you're talking to is coming out of it totally understanding what you're doing. And ideally, during that conversation, you're not just imparting kind of the wisdom of what you're doing, but you're also imparting the excitement.
Great. We're getting a question from the chat, and we're gonna answer questions in the Q&A time, but I'm just gonna, because this is sort of timely and relates to what you're saying. Do you ever consider investing in pre-seed companies or only, revenue generating companies?
Yeah, so at Growth Warrior, we're really focused on revenue generating companies. But there's tons of investors who are really good at pre-seed. And I think, something else to consider, kind of going back to that question about how to reach out to investors and how to get in touch and how to evaluate. there are investors who, will always look outside of their mandate if it's something that they're personally excited about. And so, just goes back to that idea of getting to know your investors as best as you can before you reach out to have that conversation. Because you might have somebody that you really want to work with that you look at, they're like, oh, their fund is too big. But if you look a level deeper, you might see, oh man, like 10 years ago, they actually founded a company that's in this exact same space. And so, those are the really small things that are going to get you to the first call if you're not going in through a warm introduction.
So helpful. Okay, so sometimes, founders can be in a conversation with a VC and it's gone really well, it's super positive, and they think, oh, maybe an investment is likely, but there's probably significant evaluation ahead. So can you talk about that? What typically happens internally at a venture firm after a strong first meeting?
Yeah, it's a great question. The first thing I will say is that I have to imagine that almost every meeting feels positive. And so, I would always take that with a grain of salt and kind of consider the other signals that an investor is sending you. I always tell our portfolio companies also at the end of a call with an investor, ask them, like, does this feel like a fit? How interested are you? What allocation would you be looking for? Because otherwise, you're just not going to know. And so, there is nothing wrong with being super direct and asking those questions. Most founders don't do it. I think you gain a lot of information by asking. So, number one piece of advice, like ask the question at the end of the call. Are you interested? What allocation? What check size? It's going to feel probably a little bit uncomfortable in the moment, but you will gain a lot from it. Post first call, first thing I'm doing is I'm reviewing my notes, right? I'm making sure I understood everything that happened. I'm making sure I got down all the numbers that I wanted to get. And it's really then that the real work starts, right? Typically, we're going to ask a founder to shoot over their data room. Generally, that's going to be financial model, customer list, cap table to start, and really just dive in. And so the first thing I'm doing is making sure that what you told me on the call lines up with what I see in the data room. And so, maybe you'd be surprised, maybe you wouldn't, but definitely recommend trying to make sure everything ties together. It oftentimes does not, and that's a pretty bad signal for us.
Mm.
From there, I'm really going to do a deep dive into everything that we talked about. And that's either going to end with a pass because, maybe things didn't line up. I thought it was really interesting, and it turns out maybe the market is shrinking, it's not growing. Maybe I was really excited about the opportunity and I loved you. And I love what you're doing, and it's just too early once I look at the numbers. Or, all of the stuff that you send me is going to be confirmatory. We're going to get even more excited. We're going to do reference calls and they're going to be like, oh my God, I've been looking for this solution. How have I not heard of this yet? And that's when we get to the second conversation.
It's just these details are so great. So, as an opportunity moves into your partner discussions, how does an investor who believes in a company build conviction internally? And what can founders provide that makes it easier for someone to champion their opportunity within the firm? And you've already mentioned, being having a very simplistic way of describing to your partners what the company does. But what else? Like when you're building a case or a thesis, like how can the founder assist you in that besides like things you've already mentioned?
Oh, I love this question. I love this question because very few people do this well. And when you do it well, it goes a really, really long way. So, we're a small fund, and so we're a little bit less structured than a larger fund. And so it'll be different at every fund that you talk to. But generally speaking, once something is moved to partner meeting, at least one person already has a lot of conviction in it. Generally speaking, you're going to be asked to write up an investment memo. And the investment memo is, at a very kind of low level, going to be the why now, why this team, why this market. And so the more that a founder can give me that answers those questions up front, the easier, right? Because first of all, if you don't tell me why, I'm going to have to go out and build my own why. And it might be great, but it also might be really different than what you believe to be true. And so when I get that from a founder from the get-go. It gives us alignment immediately because it helps me to understand why the founder is building in this space. It helps me to understand how they're thinking about exit paths. And it also makes it easier, right? Like that means that I don't have to go out and do all of that work because you started it for me. I'm probably going to do that work anyway. But it makes it a lot easier when there's a foundation. And so as much as a founder can give, whether it's in their deck, whether they write their own VC style investment memo that can be pulled from, that's really, really, really helpful. Essentially, like the more the guesswork is taken out of it, the easier it is. And keep in mind too, without that, I'm going into that meeting off of maybe like a 30-minute conversation and an hour conversation, right? So I'm I'm describing your business and trying to get everyone else convicted in it with 90 minutes spent with you and maybe a couple hours with your materials. That is a hell of a lot less time than what you've spent on it, right? And so as much as you can give an investor to tell your story the way that you would want it to be told, the easier it will be for them to build that conviction internally the way that you'd want it to be done.
Thank you. So, some of our founders are very VC savvy, but others are not. Can you explain the timeline that you have around investing? And sometimes, obviously, in your timeline, funds are locked up. And where can founders find the information of the investments and allotments that you've already done?
So when it comes to investments and allotments, it's kind of difficult because it's not always public. Generally speaking, PitchBook is going to be the most accurate source for that. And so that'll almost always be the best place to go to get that information. PitchBook is expensive. And so if you have existing investors, it's generally easy for us to pull down a report that we can share with you. And so definitely use your existing investors for reporting like that. TechCrunch and Crunchbase will have sort of their best guesstimates of what that looks like. And that is oftentimes a little bit more accessible than PitchBook, but those are going to be your two resources for that. Um, and then fund websites, right? Like funds are not always going to kind of write down what number they invested on a site, but that can be a really, really good resource, particularly if you're really, really interested in a specific fund. You can generally find press releases and things like that. That would be my best advice on kind of figuring out how active a fund is and what type of thing they're investing in. Was there a second question in there?
Just in terms of what the timeline usually is for VCs.
Like from first conversation to investment? It's
Mhm.
going to vary a lot. So, we are small and we move really fast. And so we have closed an investment in 30 days from the first conversation. That's really quick. And I generally would not expect that. And so, I'd say probably 30 days at the low end to as long as 6 months for a really long process. Probably the sweet spot is somewhere between, maybe like 4 to 8 weeks. But again, like it's something that you should ask in that first conversation. Hey, are you interested? How interested are you? What allocation are you looking for? What is your process? How long can I expect it to take? This is my timeline. Like these are things that, VCs don't necessarily share proactively. But if you ask, it's absolutely information that they'll give you. And to your point, Allison, like that's really helpful in your process. If you know, I really want to work with these guys, they always take 6 months to do their process. So, just because it's happened yet doesn't mean I'm not going to get a term sheet.
Rachel, obviously there's risks that come up as you dig deeper into your company research. How can founders proactively address potential concerns without creating doubt or appearing defensive with you?
That's a really good one. Because definitely defensiveness is something that is a little, I wouldn't call it a red flag, but definitely a yellow flag for us. A founder actually recently did a really good job of this. So, included in the data rooms, we had a first call. Included in the data room, he had a memo that was sort of like a state of the business as of today. And at the end of the memo, I don't remember what he called the section. But at the end of the memo, he had a section that was essentially like the concerns that I know you're going to have. And he just addressed it head on. Like it didn't come off as defensive. It didn't come off as messy. It just came off as like, hey, these are the questions that are going to come up as you do diligence. I want to answer them up front. And so that's really helpful because what I don't love is when it's an amazing first call and I'm so excited and you have 10 signed contracts and $1 million in revenue. And then I get into the data room and none of the contracts are signed and they're actually pilots and the revenue actually isn't recognized. And it depends on the situation, but for some investors, that's going to be an immediate pass, right? Because they're gonna think, damn, like, this founder wasn't truthful with me, and that's going to be a red flag for them. For others, it won't be a red flag; it'll be a yellow flag or an orange flag. But address them head on. And I think Allison, you're right. Like, you want to really avoid being defensive. Just state it as fact, right? Like, it is a fact. Let investors know up front. And also let them know what you're doing about it, right? Like if your contracts are all pilot, say, hey, all of our contracts are pilots. Here's when we expect them to convert. Here's why we expect them to convert.
And then just to dig a little deeper into revenue patterns that you like to see, and I'm sure this is obviously industry and company specific, but what are you looking, are you looking for, an upward trend? Are you looking for consistent velocity? What are the patterns that you're looking for?
All of the above, right? All of the above. And I think that it's even harder now because growth is happening so fast. We've almost moved out of the like 15% month over month growth is exceptional to now it has to be 50% month over month growth for it to be exceptional. And so, I'm looking for it to be growing as fast and sustainably as possible. And so, I'm looking for that really fast growth. I'm also looking at the underlying numbers, right? Like, did you make $100,000 more that month because you spent $200,000 on marketing? And so we want to see that top line growing really nicely. We also want to make sure that the numbers underneath it make sense and back up a story of a sustainable business that can keep growing.
So helpful. All right. So I'm curious, with fundraising momentum, it can be difficult to maintain when investors have different timelines and the process stretches over weeks or months. How should founders approach follow-up, communication, and investor updates to remain top of mind without over communicating or overwhelming someone like you?
I've been thinking about this recently. So you're going to have different camps of investors, right? You're going to have your camp of investors who is super freaking interested and super excited, and you're just going to get momentum from them. And so they're easy, right? They're the ones who are emailing you for things. They're the ones who are touching base with you. They're the ones who are asking you, how did the numbers change this week? Easy peasy. You're going to have your middle camp of investors who you genuinely like just don't know if they're interested or not. They're kind of dragging their feet. It seems like maybe they're waiting for a lead, maybe they're waiting to see who else comes in. They're responding when you email them, but otherwise they're just not super engaged. And then you have the camp of investors who like are probably out but haven't said that yet. And so generally what I love is when especially when a process is dragging on, I love a weekly update. Just shoot out a super simple email on Friday afternoon or Monday morning. Probably Friday afternoon is better since most funds have their team meetings on Monday mornings. Just saying, hey, this week we closed 3 contracts. We added 50K in revenue. Our margins continue to improve. This week they improved by 2%. Like, just get that information in front of me because that's what's going to keep me interested and keep me excited. If I'm in that middle camp and I'm not sure or I'm waiting to hear what other people are doing, which generally I don't sit in that camp, but if you have investors who are, like, that's going to help them move the needle and it's going to keep you top of mind. I think again, like maybe something that founders are not aware of, you guys are running one business, right? And so you're thinking about your one business all the time. For me and for other investors, at any given moment, we're probably diligencing 5 to 10 companies while 50 others are knocking at the door. And so our attention is always really divided. And if we're not obsessed with something because it is such a perfect fit to what we're looking for, it can be really easy for it to slip, right? And so anything that you can do, especially something like a weekly update that's backed up with metrics to stay top of mind and to remind us why we should be interested in you is really, really, really helpful. And so absolutely during your process, do that weekly update email. You're probably sending one to your existing investors already. Just tack on your prospective investors. And then for the investors that you're really, really excited about, I just ping them. Say, hey, this is our timeline. This is when we want to close. We're really excited about working with you. What can I get you to help you over the hump? What are the blockers? What are the questions that your team has that you haven't been able to answer? Can I help you answer them?
Great. So we have a couple questions that came in when people registered, and you have hit this. It sounds like metrics are really important to you, and give a competitive edge against other pitches. But when you think about your personal taste on pitches, what are you looking for? Like, what's the special sauce that you like to see?
I want to talk about it. Like the worst pitches are the ones where I sit here like this for 30 minutes. Um, because first of all, ideally, you already sent me your deck and I already read it. And so I've got questions. And so make room for conversation. Like I think a lot of this goes back to remember that you're just talking to a human and like have a human conversation. Something that I think about a lot as well. Investing is a marriage. We're going to be in it together for a really long time, whether we like it or not. And so I would almost say like think about it like a first date, right? Like that's really important. For you guys, the person that you choose to have on your cap table is somebody that you're going to call in your highest moments and your lowest moments. And if you're looking at them and you're thinking the idea of having to call this person when everything is going to hell, I don't want to do like that is not your investor. And so think about that also. Like as much as it's a pitch, it's also an interview. And so really think about it like a first date. You want to get to know the investor as much as they want to get to know you. And people love talking about themselves. And so, really, really have that be a conversation. Keep it simple, make room for them to ask questions. And just remember, like, it is a person on the other side of the table who is probably as interested in you as you are in them.
It's so helpful, all of this advice. So this is on the founder side, another registration question. So how can founders protect themselves where they're giving you a lot of proprietary information when they're pitching you, but they're not giving too much? Like, what's the balance there?
Yeah, it's a good question. I know founders think about this a lot. And my personal maybe hot take is I think that there's way too much concern with proprietary information. Like, to the point that I made earlier, we're thinking about so many different companies. We're not going to do anything, right, with that information. And so my number one piece of advice is just don't be stressed about it. Share what you feel like you need to share in order to get an investor to where they need to be to move to a second conversation. Generally, I'll speak for myself. I won't speak for all investors. Like, we're never going to share private information outside of that call. We don't sign NDAs, but we also treat everything privileged. And so don't stress about it. Like for me, it's not necessarily a red flag, but it's not a great signal when I'm in a call and I ask a question and a founder is like, oh, like I'd love to tell you, but you need to sign an NDA first, or I'd love to tell you, but that's proprietary. It doesn't feel great. It makes it difficult for me to kind of understand what I need to understand. And so I would say don't stress about it. Share what you feel like needs to be shared. Generally, also in a first conversation, like you don't need to be pulling up, like your patents and your like deepest, darkest secrets. Those will probably be reviewed during deeper diligence, but don't stress about it. Like if you think that if you're trying to figure out, oh, like this is proprietary, but I need to share it in order for them to understand, I would err on the side of sharing. And you can always put up a disclaimer, say, hey, like I really don't want you to share this publicly. You can ask if they'll sign an NDA. Generally, they probably won't. But I would say err on the side of being a little bit more relaxed about it in order to get you to where you want to go.
Great. So now I'm going to ask, when it's a no for you, Rachel, how can the founder receive the no? Is it just not that it wasn't a good fit, or should they really be getting the feedback in order to change their future pitches with other VCs?
It depends. In my experience, it is largely a temperament thing. But for me, it's a huge positive signal if I send a no and a founder responds, it's like, hey, really appreciate you letting me know. I'd love to know why. And even more so when I tell them why, and they're like, hey, I didn't think of that, or, that's really helpful. I think feedback is really hard. I also think that the data points that you'll get from investors who pass on you are some of the most valuable ones because sometimes that'll be the most honest feedback that you'll get during a process. And so, if you're going to feel emotional about it, you don't have to do it over the phone. You don't have to do it over Zoom. You can ask them to email you some feedback. But I think it's really, really, really valuable to get it and to have it and sometimes to implement it.
I love that, just honesty here. Um, this is a little bit of a question that I think, will give some tips to our founders in our community is how do you help your founders in your portfolio stay resilient, I mean, the path is difficult. Being venture funded is difficult. Do you have any, resiliency advice for our founders in this community as they proceed down this path?
Yeah, I mean, I think it's similar feedback to what I give to people who are on my side of the table, which is like take a minute, go outside, breathe in some fresh air. I think that especially during a fundraising process and especially during a hard fundraising process in a difficult market, um, it is just freaking hard, right? Like the entrepreneur journey is very much like this. And that is almost harder than just being like this. And so, give yourself credit for what you've done. I speak to a lot of founders who don't even realize how proud of themselves they should be for what they have accomplished. And so take a minute, like keep a brag sheet on your computer of like all of the things that you've accomplished, just so you could look at it and be like, damn, like I did do something. Give yourself a break. I think it's really, really hard to mentally make the choice to step away, even for an hour. It goes a long, long, long way. And surround yourself with community. The people who understand best what you're going through are the people who are going through it as well. And so, find that. And I understand NASDAQ, you guys have a bunch of programs to kind of let that happen. But I think that's huge. As an entrepreneur, as a VC, so much of what all of us do is sit in front of our computer by ourselves. And that's really freaking hard, especially when it's not going exactly the way that you planned. And so, community, outdoor time, do something for yourself, and just take a minute.
Thank you for answering that. So this question is more for, our small to medium businesses that if they do have an inkling that at some point in their growth strategy, they will be talking to VCs, how can they get prepared? If that's aspirational at this time, what would be some good growth indicators, for them to be considering in their process?
Ooh. Number one, very top of mind recently, if you don't have a finance person and you are not a finance person and the idea of your financials gives you hives, find somebody to help you. The sooner you get ahead of that, the better everything will be. And sometimes maybe something is just not quite working, or maybe you're trying to figure out what your hero metric is and you just can't put your finger on it. Even just a fractional CFO for a couple hours a week can point out exactly, hey, the exact challenge you're having is your margin is 30%. If it was 50%, everything would be better. And that's going to really, really, really help you get prepared for your first VC meeting. One, because you're going to need really clean financials for that. And number two, it'll help you understand what a venture capitalist is going to look at and be concerned about in that first conversation. That's number one. Number two, like know your metrics, know what's going on. If you don't already, make yourself a dashboard that you look at every day. Um, and I also don't think that it's ever too early to start having conversations. Some of the best investments that I've made were in founders that I had already known for as long as like 2 years, maybe even longer than that before an investment. Because that kind of lets you skip some of the like human diligence, right? If I've known you for 2 years, I've watched your business grow, you can get me on your business update list. I'm already tracking you. That means that when you're ready to go out and raise, you can just say, hey, Rachel, we've been friends for 2 years. You know what's up. We're finally ready to take your money. And that's a much easier conversation. And it really does work. And so that would be my other piece. Like, it's never too early to just start having conversations.
It's great. Okay, we're going to get into the Q&A now, and it looks like Shanika Bailey had a question that you already answered around, proprietary information and sharing that. So we're good there. And then what is your advice on maintaining a relationship with investors after the check is written and you're moving forward? And, it sounds like you've already addressed this, but do you like a quick email update or do you like a formal report? How, or both?
Yeah, so this is going to depend a lot on your stage, your relationship with your investor, what you're both looking for. For me, once we close an investment, I love, at least for the first 6 months, to do a call biweekly, every 2 weeks, because that means that anything that comes up doesn't become an emergency before I hear about it. It gives us a touch point. We're still kind of in the dating phase. It makes it easy for us to just have a point of connection. So I love that. I love at least a monthly update. But it really depends. Like I think, everybody is different. Some people like to have, a monthly 3 hour long Zoom meeting. Some people like to do everything over email. And so I think it's a really important conversation for you to have with your investor during the process. Because in addition to making sure that, it's actually somebody that you want to work with, you also want to make sure that your working styles mesh, right? Like if you're taking money from somebody who only takes meetings after 10 p.m. and you're a morning person who mainly likes email, that might not work. And these are things that seem small, but over time can compound and really become important.
Yes. So, Rachel, Nicole Davis is asking, what is your view of companies who have received federal SBIR and STTR funding? Is that a plus, a minus, or neutral?
I don't have a great answer for this one. I think it's probably going to depend on your specific investor and their perspective on taking that kind of money and also how it's gone and how it's been used and how it's kind of affected the other ways that you've taken capital. I will say on the capital formation question generally, something that founders should absolutely consider. I see, especially at the early stage, there's sort of this feeling of like equity is so cheap. I'll just sell more equity so that we can fund the business. There are so many other options that are a hell of a lot cheaper than equity. And so um, I would just say, like, when you're looking to bring capital in generally, really look at all of the options that are available to you. There's oftentimes, especially at the early stage, and especially when you need cash now, that are going to be less expensive than equity sales.
Exactly. So Luis is saying, thanks a lot for your wonderful and beautiful presentation. Um, how open are you with entrepreneurs out of the USA toward investment and administrating their requests?
So our fund is primarily US focused. And so generally speaking, we prefer for companies to have a US entity before we're able to invest. But that's going to be different for every investor. Some investors will have a North America mandate, some investors will invest globally with no issue. It's another really good question to ask during the process.
Great. And then we have Another question from Shanika. She says, if an investor likes the company but wants a larger ownership percentage than the founder is comfortable giving, how should the founder negotiate without killing the deal or the relationship?
Ooh, such a personal question. It really depends, right? Like, if it's an investor where you really feel like they're going to add so much value that it's worthwhile, you really have to decide, right? Like, I think that, every founder should probably have like a kill number, so that you don't get ahead of your skis. I think during a negotiation process, because the pressure can be so high, because there's so much going on, because maybe you've been fundraising for 3 months and you just want to be done already, you can reach a point where, maybe you end up signing something and then you regret it later. And so what I would say is lay out for yourself at the beginning of the process, like what you're comfortable with. This is the absolute most money that I'm willing to take. This is the absolute most equity that I'm willing to sell. And just stay true to that. And we're all negotiators, right, on both sides of the table. And so if you know that and you have that piece of information and you're grounded in it, go back to your investor and say, hey, I really want to work with you. This is the absolute biggest number that I can do. How can we make it work?
Hmm, so good. So, hi Annie. We have a milestone maker graduate in our webinar, which is so great. She's asking, may you share a bit about navigating prospective institutional partners that are investors?
Meaning kind of customers, or what kind of partners are we thinking?
Um, she is in health tech, so yes, partner, yes,
Okay.
probably pilot partners, that kind of thing.
Yeah, I mean, it's a great question. I think the hard piece of that is always going to be, this is less true in healthcare, more true in other spaces, but a challenge that I've come across taking money from customers is sometimes when you take money from one customer, another customer sees that as that person now has access to all of my information. I don't want to use you if that's the case. And so I'd say generally like be a little bit careful, and make sure that you're navigating that situation in a way that won't hurt the business later. But otherwise, and again, like I'm going to answer specifically to healthcare in this case, but I think oftentimes it can be great for your customers to also be investors. What you should consider is kind of two sides of the table. One, once you have that dual relationship, it's not going to be the same, right? Once they're an investor, they're a fiduciary in your business, you are a fiduciary to them. It's a different type of responsibility, and it might shift your responsibility to them as a customer. So you want to be careful of that. And on the other side, just from a cap table perspective, generally my advice on that front is that you want to keep your cap table as clean as possible. And so just consider that too, right? Like, is it $10,000 as a favor, or is it a meaningful check that, is not just going to kind of add somebody to your cap table that doesn't really need to be there?
Yeah, so Annie's clarifying, she's saying it's hospitals, a hospital system is holding a call for pitches to invest.
No, I would do it.
Great.
Easy.
Awesome. Okay, so I'm going to ask you now. She said, thanks so much. Uh, um, I'm going to ask you for a key takeaway, a golden nugget for our community.
Ooh, key takeaway. I feel like what's sticking for me is just remember that investors are human. I think it can be really difficult. I know that it can be a really, really intimidating process. I think there's the sense of like they have all of the money and therefore all of the power. At the end of the day, we're all just people who want to work with other good people. And between the two of us, you guys are the ones that are building something that's special and proprietary. And so, go into your pitch conversations, keeping that in mind, and just remembering that the person on the other side of the table is as human as you are.
Thank you for emphasizing the humanity in all of this. We just have one last question in the chat before we say goodbye. How does offering employee stock affect an investor from your experience?
Generally speaking, we will want to create an employee option pool by the Series A at the latest. And so, the effect that it has on investors downstream is going to be dilution, depending on how that's structured. But it's not a reason not to do it. It's not an
Great.
easy question to ask without all of the parameters around it. But
Exactly.
generally speaking, like, unless it's something really crazy, that's not going to be something that precludes somebody from doing an investment.
Great. And then we just have one last Q&A question with our remaining time. This is from an anonymous attendee. Can you explain more about why equity is more expensive when you were referencing all the different kinds of capital that are available?
Yeah, there's only so much of your business that exists and will exist. There are a lot of different debt vehicles. There are a lot of different loans that you can think about. There are federal grants that you can think about. There are other grant programs you can think about. There's non-dilutive funding from different types of private programs. And all of that will not affect your equity. I think, something to consider is, or something I don't think founders think about a lot, especially when you're at the early stage and you're doing safes and it's not kind of immediately affecting your ownership percentage. Eventually that number is going to get way smaller, right? You start off with 100%. As you raise money, as you sell equity, it gets smaller and smaller. And when your company is worth $1 million, that might not seem like a lot. As your company gets bigger and you have to sell more and more equity, that gets a lot more meaningful. And so that's what I mean when I say equity is expensive. There is a very precisely finite amount of it, whereas there's many other sources of money that, have a lot more flexibility in them.
Great. And just some accolades in the chat for you, Rachel. This somebody said this was very informative. So I just want to, Rachel, thank you so much for taking the time to speak to our community and share your insights and set such a great overview. On behalf of the Nasdaq Entrepreneurial Center and everyone in attendance today, we sincerely thank you for joining us.
Thank you for having me. It was a pleasure.
Great. And as we run our last poll, we would love for you to join us for our upcoming webinars. So please check out that information in the chat. That's all linked right there in the chat for you to click on. And thank you all so much for joining us today. We look forward to welcoming you back online with us very soon.